So, in the last lesson, we learned that traders trade financial instruments and we looked at what financial instruments are. I'm keen to find out what I can actually trade and, more importantly, how to do it.
I admire your enthusiasm. In this lesson, we are going to introduce a popular type of trading called margin trading. After the next couple of lessons, you'll hopefully see why diving in without knowing the risks could be fatal to your trading career. Remember when you were learning to drive? You didn't jump in a car and drive down the motorway straight away. You took lessons and gradually built up your skills. Over time, you became more experienced and now it comes as second nature. It's the same with trading the markets.
Don't worry, I won't rush off and start trading just yet. But tell us about margin trading.
Margin trading is, in effect, when the trader borrows money from their broker, so they do not have to fund the whole position. Before a trader can trade like this, they need to deposit some money with their broker. This is called the margin. It's normally a fraction of the total size of the trade.
I'm still a bit lost. Can you break it down a little more?
Sure. A real-life example will help us here. For example, have you ever bought a property? How much did it cost and how much was your mortgage?
Yeah, I have a flat. I bought it for about 260,000 and I needed a 200 grand mortgage.
Okay, so you've borrowed £200,000 and you put up £60,000 to pay the total price of £260,000. In trading, we would call this your position. If the flat increases in value to £300,000, you've made £40,000, which is all yours. But the capital you personally invested was £60,000 and not the full price of the flat.
Yeah, I understand. But I don't get how this ties in with trading.
Well, think of it this way. Instead of purchasing your flat, you are purchasing a financial instrument like shares.
Okay, can you take me through that?
Sure, let's look back at the BP example from the last lesson, where we've purchased 100 shares for £5 each. If you did this in the cash market and purchased the shares outright, you would need £500 to invest. With margin trading, you might only need to put up, let's say, 10% or £50 to buy the same 100 shares. The broker will in effect lend you the £450. This is also called leveraged. In this example, the margin is the £50 that you have to place with the broker.
And is the £500 my position?
Exactly. The 500 is your position. It's also referred to as the notional position, but don't worry too much about that now.
So when the share price moves to £5.50, do I still make £50?
Yes, you'll make £50, but instead of it being on an investment of 500, it's on an investment of 50. So you've moved from a return on capital of 10% to one of a 100%.
This sounds like a fantastic way to trade, only having to put up a small amount of the money needed.
It is, but it carries huge risks that you will need to manage carefully. We'll cover the biggest one in the next topic. When you trade using margin, you are effectively borrowing money. This provides leverage to your trading. To properly understand trading, you need to understand leverage. It has its rewards, but it also carries risks, so you need to be proactive in managing it.
Okay, I'm listening.
As we saw in our BP example, the obvious benefit of leverage is that it significantly enhances our return on investment. This means the percentage we get back from our initial investment is improved with margin trading. Let's look back at our BP example again. Using margin trading, we increased our overall returns and we achieved a 100% return on our initial investments of £50 instead of only a 10% return on our cash purchase of £500. The BP share price had the same increase in both cases from £5 to £5.50, but when we used leverage, our return greatly increased.
Yes, I see that. That's a really big improvement.
Good. So, the second benefit of leverage is that theoretically, it enables you to have a larger pool of resources to trade.
Go on.
With the original BP trade, we had £500 available to buy the 100 shares outright. When we traded on margin, we only needed £50 to make a trade for the equivalent 100 shares. Then we had £450 uninvested. If you wanted to maximize your exposure to BP, then you could, in theory, use all £500 as the margin and increase the number of equivalent shares purchased to 1,000. This gives you a total exposure of £5,000. If you placed the same trade and exited when the price hit £5.50 as before, instead of £50, you'd make a £500 profit. Another way to look at it is when your £500 of capital is leveraged 10 times, you have an exposure of £5,000.
Why 10 times, Philip?
Well, that comes from the broker in the form of the amount of money.
Hi, this is the last lesson in our What Can You Trade module.
We are going to take a look at 3 types of margin trading: CFD trading, spread betting, and margined Forex trading.
Sounds good. Let's get started.
Just before we begin, I want to stress that these products are all fairly similar, although you will need to know the differences. In the grand scheme of things, they are only very slight.
Okay, so how are they similar?
Well, for starters, they are all margin trading products. And of course, we know that this means that they have the benefits, but also the pitfalls of leverage. As a private trader, you can access all 3 types fairly easily through an online broker.
Are there any more similarities?
Yes, CFD trading and spread betting will let you trade the price of thousands of Forex, index, individual equity, commodity, and bond markets.
Okay, and what about margined Forex trading?
Margined Forex trading only allows you to trade the currency markets. However, it's worth noting that you can also trade currency CFDs and spread bets. All types of trading have similar minimum price moves and margin requirements. This means the leverage you can obtain from each type is pretty much the same. All types of trading, if done successfully, will require the same analysis, risk management techniques, and approach to trading psychology.
Okay, great. So which ones are we covering first?
Let's take a look at CFDs. Remember at the start of this module when we looked at cash and derivative instruments?
Yes, I remember. When a flower seller sells to a customer at his stall, that's a cash instrument. And if we were to bet on the price of the flowers, that would be a derivative instrument.
Good. When you enter a CFD trade, you are agreeing with the other party, normally your broker, to exchange the difference in price of an underlying asset. It's a classic derivative instrument. Typically, they are not traded via a central exchange, and also they're known as being traded in an over-the-counter market. We'll cover OTC markets in the next module.
What do you mean, difference in price?
Well, this is the difference between the entry point of the CFD and the exit point. If we think back to our first BP share example, a CFD would be a contract for the difference between the £5 entry price and the £5.50 exit price. You and the other party are only agreeing to exchange the 50 pence difference.
Ah, okay, I understand. So it does what it says on the tin. It's a contract for the difference.
Exactly. An important point to note here. As a trader, you don't own the underlying asset. You are only interested in the change of its price. It's a bit like our flower trader example. We don't own the flowers. We are only interested in the price at which others are buying and selling them.
Got it. But how do we know what the underlying asset is that we're trading?
Well, that's defined beforehand. For private traders, CFDs are standardized and the name on the contract will be clearly labeled. For example, BP CFD or UK 100 CFD.
Good. Just checking.
A few decades ago, CFDs started being used by asset managers in the city to hedge shares. To begin with, the managers just hedged individual shares, but this evolved into them using different underlying assets such as indices and Forex.
What does hedged mean, Philip?
A hedge is when someone performs a transaction to offset an existing investment or risk. A hedge might happen if it's difficult or expensive to sell the initial investment.
I'm still not clear on this one. Can you give an example?
Sure. Let's show this on a chart to make things easier. So, if you use our BP example again, let's say a UK-based investor owns 100 BP shares, and let's use the actual price in the chart, £4.80. They are nervous about a short-term event that they think might impact the share price. They still want to own the shares in the long run, but they want to protect themselves against the potential short-term move. This happens a lot in investing, where events like a change of government, CEO leaving, oil price volatility, and so can bring short-term concerns to investors. The first option our investor has is to sell the shares and repurchase them when the risk has been averted. But this involves significant transaction costs and a 0.5% UK stamp duty charge when the shares are repurchased.
So it's expensive to sell and repurchase shares?
Relatively so, yes. Instead, they can sell 100 CFDs to cover the value of the shares. That means if the price falls below £4.80, they make the difference multiplied by the 100 contracts. They can buy the CFDs back when they are confident that the short-term risk has passed. Because they aren't trading the actual shares, they don't incur the stamp duty charge, only a relatively small commission and funding charge from the broker. This way, they can keep on owning the shares and protect against the short-term risk while the CFD is open. Let's fast forward our chart to see what happens to the price and both positions. If the price falls, the profit on the CFDs offsets the losses on the underlying shares.
I see. So it's a way of protecting against falling prices?
Not necessarily. If we fast forward again, while still holding the CFD hedge, we see that if the share price go up above the entry price of £4.80, the CFD starts incurring a loss because the difference in price is no longer in the investor's favor. This loss is offset by the profit on the shares.
So it's used to get you out of the market without actually selling your shares?
Yes, but only if you fully hedge. In this example, selling the 100 CFDs hedges the 100 shares exactly. What the first users of CFDs realized pretty quickly is that you can use them not only for hedging, but for speculation as well. If you think the price will rise, you buy a CFD. If you think the price will fall, you sell it. We'll be looking at buying and selling in the next module, so we won't go into too much detail here. If traders are only interested in price differences, why bother owning the underlying shares at all? Why not just buy or sell a contract for the difference?
Ah, I see. So, instead of us having 100 BP shares, we have 100 BP CFDs.
Exactly. Traders do this a lot. The next big advance came when the internet was introduced to the masses at the end of the 90s. Before then, CFDs were only really used between banks, hedge funds, and institutions. Large private investors got access via specialist brokers, but CFDs were certainly not a mass market product.
Before my time, Philip. I was still at prep school then.
The internet has really helped distribute CFDs inexpensively to private investors and traders. With this growth and a good degree of competition, we've seen a lot of innovation surrounding the product. It became quick and easy to trade. The cost of trading has plummeted and the range of markets offered has widened. As well as individual equity CFDs, you can now trade index, Forex, commodity, and bond CFDs. You can even trade cryptocurrency and property CFDs. The choice is impressive.
So have I got this right? CFDs are still used by big financial institutions, but now lots of private traders like me are also using them.
Yes, correct. CFDs are also used by non-financial companies to manage risk, like food manufacturers, farmers, and miners. And they're still used by long-term investors for hedging their portfolios. In addition to the reasons we just looked at, these types of users like CFDs because normally you can offset any losses that come from trading against corporation or capital gains tax. This is a bit technical, but basically it means that the taxman is happy for you to offset the side of the transaction that makes the profit with the side that makes the loss.
I can see why that is useful.
Good. Now, that just about covers the main points on CFD. Next up, we are going to introduce a close relation to the CFDs.
In the last lesson, we were introduced to CFDs. As Philip explained, they're a popular margined trading product used by nearly all market participants to balance risk efficiently.
That's right. In this lesson, we are going to introduce financial spread betting. Like CFDs, this is a derivative OTC product. When you place a financial spread bet, you are entering into a transaction with your broker.
So, we're not buying the underlying asset like we would with a normal share purchase.
No, you are learning quickly. This is purely a bet on the price of an underlying asset or market between you and the broker. As with CFDs, this means if you are betting on UK shares, you don't pay any stamp duty on the trade.
Okay, how do spread bets actually work?
Instead of buying contracts as you do with CFDs, when you place a financial spread bet, you specify the amount per point you'd like to bet. This is known as your stake size.
What's a point?
A point is a predetermined unit of price that the underlying market might move by. For example, if you placed a spread bet on the price of the FTSE 100 index at 7,300, a 1 point move up would be to 7,301. However, it's worth noting that the exact definition of a point changes depending on the market and the broker. It's important that you read the market information provided by the broker to make sure you really know what you are betting on. If the market price moves in your favor by a point, you make your stake. If it moves against you by 1 point, you lose your stake. If the market moves 100 points in your favor, you make 100 times your stake. If it moves 100 points against you, you lose 100 times your stake, and so on.
Is there any limit to how far a market can move?
No, not really, but there are risk management tools that we are going to discuss in our module on understanding risk that enable traders to limit the potential move.
Okay, so I pick the market I want to trade in and specify my stake, which is how much I think the price will move per point. Who decides when the bet ends?
Good question. It would normally be you, the trader, who decides when the bet ends, so long as you ensure your account is properly funded and you have enough margin in it. Remember, if the trade starts making a loss, a broker might ask you to provide more margin. The most popular spread bets are called daily funded bets, which used to expire at the end of the day. However, brokers started giving their clients the option to roll over the bet to the next trading day. Now, this happens automatically.
I don't really get this.
Don't worry too much about this for now. It becomes fairly obvious when you start working with a practice trading account. At this stage, all you need to understand is that it is up to you to decide when to close a bet, so long as you maintain enough margin.
I know we're covering this later, but you mentioned CFD traders can speculate that the price will fall as well as rise. Can you do that with spread betting?
Yes, just like CFD trading, being able to speculate is one of the main benefits of spread betting. It's a bet on price, so it's down to you to say which way you want the bet to go.
I can see there are a lot of similarities and a few minor differences between a CFD and a spread bet, but are there any big ones?
The main one is tax. In the UK and Ireland, as an individual, when you bet on something and win, whether it be sports or financial markets, it's normally tax-free. So, if you spread bet and win, then you normally don't pay capital gains tax.
Wow, that's a big benefit.
It is, but conversely, if you lose, then your losses are not tax deductible. That's why financial spread betting isn't normally a very good product to hedge with. So, for our long-term investor looking to hedge a share or a company looking to hedge a risk, it isn't the best option because they can't offset profits with losses.
Oh, I see.
Think of financial spread betting as a product purely for price speculation by individual traders. Like CFDs, traders can spread bet on the same wide range of markets: indices, Forex, commodities, bonds, and shares. Let's go through an example.
So, can you show me an example of a spread bet on the FTSE 100?
Sure. In spread betting, the FTSE 100 market is referred to as the UK 100. This is mainly because of the trademark rules, but let's not worry about that here. Let's pull up a chart again. This is the UK 100 market, and we are at this point in time. So, what stake do you want to bet, and which direction do you think the market will go?
Okay, let's say I want my stake to be £1, but I'm not sure which way it will go.
Don't worry, just for the example, take a guess. If trading with real money, you'd be doing lots of analysis to work out your view and whether you'd want to trade.
I think the price will go up.
Okay, so I place a spread bet here at 7,450 for £1 a point that the market will go up. In trader speak, I am going long. Let's wind the chart forward and see what happens to the price. So, the market price has gone against your prediction. If I exited my spread bet here at 7,350, I would have lost £100 on the trade. That's 100 points at £1 a point.
What would have happened if I said it would have fallen?
Thankfully, in our example, we can rewind. In real life, you can't. If I had bet that it would fall here, and if it falls to 7,350, then I would have made £100.
That's more like it. And the £100 would be tax-free?
Yes, probably. In the UK and Ireland, because of this tax benefit, spread betting is the most popular margin trading product for private traders. Well, that wraps up our discussion on the financial spread betting. Next, we are going to take a look at margin Forex trading. At the start of this module, we looked at the definition of a financial instrument. One of the asset classes was foreign exchange, which is also known as Forex or FX for short.
Oh yeah, I remember. That's the market where currencies change hands.
It certainly is. When we are talking about margin Forex trading, we are normally referring to transactions on the cash Forex market, which is also known as the spot Forex market. This is where traders buy one type of currency and sell another.
Okay, that makes sense. But how does the cash part work in Forex?
Well, in a Forex market, you agree the price at which to exchange currencies today and not at some date in the future. In actual fact, most spot currency markets give you 2 business days to settle up and pay what you've agreed. But for all intents and purposes, think of it as agreeing a price now for immediate delivery.
Okay, what do you mean when you say immediate delivery?
In a spot FX transaction, if you are buying, say, 130 US dollars and selling 100 British pounds, you'll need that 100 pounds in your account before you trade. On settlement, your broker will put 130 US dollars into your account.
Okay, that's fairly straightforward. But where does margin and leverage come into it?
Ah, yes, okay. The numbers I just gave you are only illustrative. A standardized spot FX contract is for 100,000 of the base currency. This standardized contract is called a lot. That means if you wanted to carry out a transaction for just one lot, unleveraged, you would need to deposit £100,000 and receive $130,000.
Wow, that's a lot of money.
It is. That's why brokers provide a lot of leverage for margined spot FX transactions. A normal amount of leverage for the sterling dollar pair is about 200 to 1. This means you need to deposit the equivalent of a £500 margin with the broker to trade this particular contract.
That's still a decent amount. Can you still decide on which way you want to speculate on price?
Yes, you can buy or sell one currency against another. Basically, it's the same process as betting on whether a price will rise or fall.
And what about the tax aspects? There were important differences in CFDs and spread bets.
Well, margin Forex trading has similar tax rules to CFD trading. If you make a profit, you normally pay tax on it. If you make a loss, it's normally deductible. In the UK and Ireland, it's really only spread betting that is capital gains tax-free.
And what about stamp duty?
Spot Forex doesn't incur any stamp duty. It's normally only shares that incur stamp duty in the UK.
Okay, thanks. I'm still a bit confused about Forex. You said traders can place CFD trades and spread bets on FX markets, but there is also a separate product called margined Forex trading.
Ah, yes, that's a bit confusing. It's important to understand that margin Forex trading developed before CFDs and spread betting came about. For private traders in the UK and Ireland, CFDs and spread bets offer a better range of markets and a choice of tax benefits, but have similar margin requirements in some countries like the US. Private traders are not allowed to speculate on CFDs or spread bet, so they naturally gravitate towards margin Forex trading.
Okay, I'm with you.
Well, margin Forex trading is technically different. For starters, it is a cash market, so traders exchange the underlying currencies, even if the broker is funding most of it. Some traders, normally large ones, take comfort in the fact that they are dealing in the underlying cash market and not directly with a broker, as you do when you trade CFDs and spread bet. But for a private trader, that shouldn't be a concern. With all three product types, you are speculating on the price movement of the FX market.
So which product should I choose?
It's really down to individual circumstances and preferences. If you're based in the UK and Ireland and want to purely speculate, it's likely to be spread betting. If you are in the US, then margin Forex is probably your only option. So that finishes our explanation on margin Forex trading. That's the final margin trading product I wanted to introduce you to.
We've been introduced to three different types of margin trading: CFDs, financial spread bets, and margined FX. They all have differences, but they also have big similarities.
All three are margined products, which means they involve leverage, which can bring both risk and rewards. All three give traders the ability to speculate on the price movements of financial instruments.
A CFD is a contract for difference. This is used by investors to hedge and by traders to speculate. There's a wide range of markets out there, including indices, Forex, shares, commodities, and bonds which you can buy or sell. Because you don't own the underlying asset, as with spread betting, you avoid stamp duty on UK share transactions.
A financial spread bet is where traders set the stake they want to bet per point. Spread bets are purely used for speculation and are popular in the UK and Ireland because profits are tax-free. Because losses are not deductible, they're difficult to use for hedging.
Margined Forex trading is different from trading FX, CFDs, or FX spread bets. But the underlying markets are the same. Margined Forex is traded in lots and allows you access to the underlying cash market. This involves swapping the currencies, but doesn't extend the indices, commodities, bonds or shares.
Well done, everyone. I appreciate that got a bit heavy. You've now finished the module. To help things sink in a little, we'll spend a few minutes going over what we've learned in the next video.